Every 4 years, Bitcoin's block reward halves. In 2012, from 50 to 25 Bitcoin per block. In 2016, from 25 to 12.5. In 2020, from 12.5 to 6.25. In April 2024, from 6.25 to 3.125. In each of the 3 prior cases, a major Bitcoin bull market followed within 12 to 18 months. After the 2012 halving, Bitcoin rose from $12 to $1,150, a 9,000% gain. After the 2016 halving, from $650 to $19,800, a 3,000% gain. After the 2020 halving, from $8,700 to $68,000, a 680% gain. The halving cycle is the most widely followed macro pattern in crypto, and it has an unblemished track record across 3 iterations. Is this a structural supply-demand phenomenon that will repeat with the 2024 halving? Or is 4 data points insufficient to establish a reliable pattern? For institutional investors considering allocation timing around halvings, these are not rhetorical questions. They are the basis of a multi-billion-dollar investment thesis. The halving cycle thesis rests on a supply shock argument with a specific mechanism. Before a halving, miners produce a certain number of new Bitcoin per day, approximately 900 before the 2024 halving, dropping to 450 after. At current prices, this represents $30 to $45 million in daily new supply that miners must sell to cover operating costs. When the halving cuts this supply in half, the daily sell pressure from miners drops by $15 to $22 million, in a market where even small supply-demand imbalances drive significant price moves. The stock-to-flow model, popularized by analyst Plan B, formalizes this relationship, predicting Bitcoin's price based on the ratio of existing supply to annual new production. The model correctly predicted Bitcoin's order of magnitude price appreciation across all 3 prior halvings. However, stock-to-flow relies on the assumption that demand remains constant or grows. If demand falls faster than supply contracts, the halving thesis fails regardless of the supply shock. The quantitative halving cycle data is compelling but limited. The 2012 halving produced a 9,000% price increase from trough to peak over 12 months. The 2016 halving produced a 3,000% increase over 18 months. The 2020 halving produced a 680% increase over 18 months. The declining magnitude of post-halving rallies is itself an important data point. As Bitcoin's market cap grows, the percentage move required to absorb the same dollar value of supply reduction diminishes. The 2024 halving occurred in April 2024 at a Bitcoin price of approximately $64,000. By Q1 2026, Bitcoin had reached new all-time highs above $100,000, a 56% gain in under 12 months, broadly consistent with the cycle pattern albeit at lower magnitude than prior cycles. The declining return profile is mathematically expected as the market matures and the supply reduction becomes a smaller percentage of total market capitalization. The institutional debate on the halving thesis divides between supply fundamentalists and narrative skeptics. Supply fundamentalists argue that the halving creates a mathematically predictable reduction in sell pressure that, combined with growing institutional demand from spot ETFs and corporate treasuries, creates a durable supply-demand imbalance. The spot ETF launch in January 2024 introduced an additional demand absorber. BlackRock alone was buying more Bitcoin per day in early 2024 than the entire post-halving daily miner production. Narrative skeptics argue that the halving pattern is a self-fulfilling prophecy. Investors buy Bitcoin in anticipation of a post-halving rally, which causes the rally, which validates the pattern, which causes more buying in the next cycle. Both arguments are partially correct, and the institutional answer is that the thesis is more robust when supply fundamentals align with genuine demand growth, which is currently the case with spot ETF adoption. The halving cycle thesis carries specific risks for institutions that base allocation timing on it. Pattern degradation risk is primary. Declining magnitudes across each cycle suggest diminishing returns from the supply shock mechanism as Bitcoin's market cap grows. Timing risk is critical. The halving creates supply pressure over 12 to 18 months, not immediately. Institutions that front-run the halving by 12 months may face a 12-month holding period before the thesis delivers, which creates mark-to-market risk if other macro factors create interim drawdowns. Third is the failed cycle risk. The halving thesis has 4 data points. If the 2024 cycle fails to produce a significant post-halving rally, perhaps due to macroeconomic tightening overwhelming the supply shock, the entire thesis is invalidated and institutional allocators who timed exposure around it face maximum drawdown. BlackRock's ETF timing relative to the 2024 halving provides the clearest institutional case study on the interaction of structural demand with supply cycle dynamics. BlackRock IBIT launched in January 2024, 3 months before the April 2024 halving, and in its first months, purchased approximately 10,000 Bitcoin per day, which was more than double the pre-halving daily miner production of 900 Bitcoin. This institutional ETF buying created a structural demand surge that effectively front-ran the halving supply shock. When the halving reduced miner supply from 900 to 450 Bitcoin per day, institutional ETF demand had already been compressing available supply for 3 months. The combined effect, demand surge and supply shock, produced the 2024 bull market that took Bitcoin to new all-time highs above $100,000. The case study demonstrates that the halving thesis in 2024 was amplified, not driven, by the supply shock alone. Institutional investors building a halving cycle-aware allocation framework should apply a 4-step evaluation process. Step 1 is supply-demand modeling. Build a quantitative model of post-halving daily supply reduction versus current institutional and retail demand flows to assess whether the supply shock is material at current market capitalization. Step 2 is macro overlay. Assess whether the current macroeconomic environment, monetary policy, credit conditions, risk appetite, is supportive or hostile to the halving thesis. The 2022 cycle failed to produce the expected bull market because Federal Reserve rate hikes created a risk-off environment that overwhelmed the supply shock. Step 3 is cycle positioning. If the framework is supportive, build allocation timing around 12 to 24-month windows centered on the halving rather than trying to time the exact post-halving rally peak. Step 4 is magnitude calibration. Adjust return expectations based on declining magnitude trend. Planning for 680% returns at current market cap is analytically indefensible. 3 halving cycle mistakes define poor institutional timing. First, extrapolating prior percentage returns to current market cap. At Bitcoin's current capitalization, a 2012-style 9,000% rally would require a $180 trillion asset, which exceeds total global wealth. Second, treating the halving as a precise timing catalyst rather than a multi-month supply pressure process. The bull markets in prior cycles developed over 12 to 18 months, not in the weeks immediately following the halving. Third, ignoring macroeconomic override conditions. The 2022 Fed tightening cycle overwhelmed every bullish Bitcoin thesis, including the supply shock mechanism. Macro environment must be assessed before the supply cycle thesis can be validly applied. The halving cycle thesis is the most widely followed pattern in crypto investment, and it has delivered in every prior iteration. But institutional investors must evaluate it with declining magnitude expectations, macro overlay requirements, and realistic timing windows. The 2024 cycle showed it working again, amplified by spot ETF demand. But the supply shock mechanism grows proportionally smaller each cycle as market cap expands. The halving cycle is one of the most studied patterns in crypto, and it requires rigorous analytical framework to apply correctly in institutional portfolio management. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.